Welcome everyone to Charts Focus 1, where we teach you how to work hard and trade smart. In this video, I want to give you guys a fresh outlook on where the broader markets can go from this point forward using the correlation between the 10-year bond yield, bond prices, and the US dollar, but with a twist at the end. Now, as members of the CFO Swing Watch newsletter know, we have been calling for a market rally since early December. Multiple indications were flashing green, especially what we like to call the market internals or breadth, which was basically saying that we needed to start accumulating into long positions. And that's exactly what we did as we continue to look at great technical chart setups. Then we patiently waited until the rally began right at the start of this year and profited well off of those long positions. But where do we go from here? Well, before I dive into the charts here, I need to tell you guys this. So, as the members have already been notified right before the year started, remember this or write this down somewhere. The markets in 2023 will become desensitized to every important incoming economic data and the future monetary policy moves that the Federal Reserve makes. I have given a plethora of evidence that this could very well be the case for this year in the newsletters. So if you guys want to know what that evidence is, go to the description box below and click on the very first link. Now, as a disclaimer, if you have clicked on this video thinking that I will be making a full bearish case on the market, you are wrong. Instead, I will be giving you guys an insight as to why we are most definitely not going to have a huge crash as most people on FinTwit have been shouting for at the top of their lungs. Remember, it has been popular to be bearish on Twitter and calling for market crashes, but it has been correct to be bullish in the past 2 months. There is a clear difference. Okay, so with that, let's first go over SPY. So for the past 2 weeks, we have been making quite the constructive pullback as we continue to let off this rally's steam from December 2022 lows. And this pullback from 418.31 has allowed us to make a nice daily bull flag, which can potentially break out to make a second leg higher. And if we do, we can see a huge level at 420, and we can retest this level. And this level can be seen on the daily and even on the weekly. And now the daily 10 and 21 SMAs, which is my momentum pair SMAs, so my red line here and my light blue line here, the 10 and 21, are still curling higher even if we are now retesting both of them. And it makes sense because we are making a nice daily bull flag. We're seeing sideways price action. So all we need to do is have a clear volume backed breakout over 414.50 to 415 and continue to move higher until we hit that previous pivot high point of 418.31 and then eventually retest this heavy level of resistance at 420. So clearly, we are still seeing a very nice bullish uptrend with constructive pullbacks and much needed sideways price action. Now, let us talk about the rest of the charts that may change your own viewpoint on the SPY chart. So the first one here is the 10-year Treasury note bond yield. And this one has been downtrending since early November, and it peaked at early November as well. Now, there is a clear character change here on the price of the yield, right? Or the number, I would say, the value of the yield here. And we can clearly see, even though we can't really chart the yields here, okay, but we're working with what we know here on the candlestick chart. And we have this descending resistance trend line. And for the past 2 days, all right, we've retested this descending level of resistance as new support. And today we closed with a nice candlestick higher, confirming that yesterday's candlestick was indeed a retest of this descending level of old resistance to turn it into a new level of support. And so this is usually a warning sign for equity markets. And with the 10-year really on the spotlight, and people are constantly checking where the yields are at, this is kind of spooking investors because, again, for most of 2022, we saw the bond yields absolutely skyrocketing higher. And so with this potential character change here and the price change or value change of the yield, this can bring back some fear in the markets. And then next we have the 20 plus year Treasury bond ETF. So since we just talked about bond yields, it makes sense to look at bond prices. Why? Well, because they have an inverse relationship. And that means that if the bond yields go up, then bond prices go down. And then vice versa, right? If the bond yields go down, then the bond prices will go up. And so TLT here has been seeing a very, very nice uptrend. But it is at a very precarious area. And as we've been seeing, the 10-year yield moving to the upside and breaking out of this descending level of resistance. TLT is on the verge of breaking below this ascending support trend line. And depending on what we do for the next couple of days, the bond price here can either break down and head back down to this previous area of strong support around 100 to around 99.20ish or around 99. And we can potentially see another bounce there. However, if we see a constructive pullback on the bond yields here, we can also see bond prices holding around between 103 to 104 and kind of forming a range, small base, I would say, between these two whole number prices. Now, the reason why I'm telling you this is that there has been some call flows for TLT here that came in today and yesterday. And I just want to make note that we are at a very pivotal area. And if we're able to hold and reclaim this ascending support trend line, there is a possibility for us to retest this major level of resistance that we cannot get over since this rally started on bond prices. And so if we retest it for a third time, since we have already retested it once here and then a second time over here, then we can see a potential breakout on a macro bullish ascending triangle chart pattern. All right, and the last chart that I want to see here, all right, let's take this one out, is the US dollar, DXY, right? The US dollar currency index. So this one, I can't really chart this one as well, but since we are using the candlestick charts here, it's good to use what we can work with, right? So the DXY has been forming this very, very nice bull flag. And as you guys can clearly see on the daily time frame here, the 10 SMA, my red line, has crossed over the 21 SMA. So the short-term momentum is to the upside. And then today, currently, we're seeing the 10 SMA crossing above the daily 50 SMA. Sure, we've had a break of the 50 SMA below the daily 200 right over here, and this marks what we call a death cross when we have the 50 breaking below the 200. And generally, when we have a smaller SMA breaking below a larger SMA, that's considered very, very bearish. And on the opposite, when we have a smaller SMA crossing above a larger SMA, that tends to be a very bullish indication. And that's the reason why when we take a look at the 10 and 21 SMA, the short-term momentum and trend for the dollar is to the upside. And that's another reason why we've been seeing gold prices crashing along with other commodities, right? We've been seeing a reversal in gold prices and silver prices, right? And so if the DXY, the US dollar, continues to, trudge upwards and higher, we can see more fear coming back into the markets as I would also see the bond yields going higher as well. Now, with all of that technical analysis in mind for bond yields, bond prices in the US dollar, here's what I truly believe. I'm not going to focus as much on any of these three anymore. Why? Well, as I've said at the start of this video, the market is really ignoring and forgetting about what the Federal Reserve will do in the long term. We saw evidence of this when we started this current rally. So basically, the market is leading the Fed here. And if the market is truly, really leading the Fed, and the market is completely desensitized to economic news and data, the rise of the US dollar, DXY, and the bond yields, TNX, specifically the 10-year yield, shouldn't really be much of a concern anymore. The equity markets will hardly react to further bounces, advances, and breakouts on the dollar and bond yields, as we'll only use them as reference points as to what the Fed will do next. Our first confirmation of the market acting in this way was its reaction to January's CPI report and jobs report. Even with the small advance of inflation in January, the markets didn't care at all for the fact that the Federal Reserve may increase the target for their terminal interest rate or the federal funds rate, as they have not broken the tight labor market as well. So in all, we basically have no need to be so bearish when it's been correct to be bullish for the past 2 months. Just because of the fact that we are seeing these rises, okay, that indicate bearish activity for the equity markets, does not mean that we are going to be seeing a huge market crash. Now, do understand that we are still in consolidation mode for the markets right now, as described in the technical analysis for SPY a few minutes earlier. So we will most likely have a slight short-term reaction from the confluence of data that we're getting from bond yields, bond prices, and the US dollar. I am just not calling for a huge market crash. That is the reality here so far with how the current market is moving and how the different components in the market are affecting the macro perspective. So I will leave you guys with this. It is time to ignore the macro, as the market has been doing that for the past 2 months. Look for individual names with great technical chart setups and focus on them without thinking too much about what the market will do, especially when we are consolidating like this. I truly believe that 2023 will be a year of digressing away from all the headlines about the dollar, inflation, bond yields, labor market, and etc. Alright, that is it for this video. If you liked what you heard, please leave a thumbs up down below, and if you're new here, check out the description box below for the subscription link to the CFO Swing and Watch newsletter. And make sure you check out the other videos on this channel if you're in for more information-filled videos. Thank you so much for watching, and I will see you all on another video.